What happens if everyone withdraws their money? If you have $10,000 in your bank account right now, your bank is legally allowed to lend most of it to someone else. And if everyone tried to withdraw their money tomorrow, there wouldn't be enough because the money in your account is not fully there. It has been multiplied, used, reissued. The modern US and UK banking system does not store money, it manufactures it. And almost nobody truly understands what that means until confidence is tested. You were raised to believe banks are vaults, secure, conservative, protective, a place where money sits. But legally, the moment you deposit funds, something subtle happens. Your physical cash disappears into the system. What replaces it is a claim, an IOU. Your balance is not stored currency. It is the bank's liability to you. That distinction sounds technical. It is not, because banks are not warehouses. They are leverage machines. Here's what actually happens. You deposit $10,000. The bank does not lock it away. It keeps a small buffer for expected withdrawals. The rest becomes lending power. A mortgage for a family in Ohio, a small business loan in Manchester, a car financed in Texas. But here's the part most people never hear clearly. When that loan is approved, the bank does not transfer someone else's deposit. It creates a new one. Digits appear in the borrower's account. New purchasing power. Your $10,000 still shows in your balance. The borrower now has $9,000, two balances, one original deposit, that is money creation, and this is not corruption, it is architecture. Over 90% of money in the United States exists digitally. In the United Kingdom, the figure is nearly identical. Cash is a shadow of the system. What we call money is largely a web of digital obligations, and that web expands through debt. Loans create deposits, deposits create spending, spending drives GDP. The system grows through credit expansion. But expansion assumes stability. It assumes withdrawals are staggered. It assumes behavior follows patterns. What it does not assume is collective panic. Now let's stress the system. Imagine a credible rumor surfaces. A major bank is overexposed. Nothing confirmed. But analysts start questioning liquidity. Social media accelerates speculation. Large depositors begin transferring funds. Not in lines outside branches, but in silent digital exits. Millions move with a tap. This is not the 1930s, this is instantaneous. Withdrawals surge, interbank markets tighten, short-term funding costs spike. That is when fragility becomes visible, because banks do not hold full reserves, they hold expectations. What happens next is mechanical. Banks borrow overnight from each other. They tap repurchase agreements, they sell liquid securities. But if uncertainty spreads across institutions, trust between banks weakens. And when banks stop trusting each other, the real system slows. Payment settlement strains. Corporate payroll cycles face friction. Credit cards still swipe. But behind the scenes, liquidity desks are watching flows minute by minute. The danger is not empty vaults, it is frozen settlement. Let's escalate further. What if this isn't one bank? What if coordinated fear grips multiple institutions? Withdrawals accelerate, large corporate accounts move first. Treasury desks pull liquidity defensively, money market funds restrict exposure, interbank lending narrows sharply, funding spreads widen. The central bank steps in. In the US, the Federal Reserve activates emergency liquidity facilities. In the UK, the Bank of England expands repo operations. They inject reserves, they calm markets, because the system is not designed to absorb synchronized withdrawal. It is designed to absorb statistical variance. There is a difference. Here's what most people misunderstand. A bank does not collapse simply because it lacks vault cash. It collapses when confidence collapses, because banking is built on a confidence multiplier. Deposits are promises, loans are promises, settlement systems are promises. If everyone demands fulfillment simultaneously, the multiplier reverses, credit contracts, liquidity tightens, asset prices fall, and falling asset prices create new fear. The loop feeds itself. We have seen fragments of this. Northern Rock in 2007, lines outside branches in the UK, televised panic. In 2008, US institutions fell rapidly once liquidity vanished. Not because every loan defaulted overnight, but because funding markets froze. Banks rely on short-term borrowing. If they cannot roll over funding, they fail. Confidence is oxygen. Without it, leverage suffocates. Now imagine the extreme scenario. Every depositor in America and Britain attempts to withdraw funds within 48 hours. What happens? First, digital transfer limits appear, not labeled as panic, labeled as security protocols. Second, central banks flood the system with reserves. Balance sheets expand aggressively. Third, public assurances, deposit guarantees emphasized, government statements issued. The objective is not technical solvency, it is psychological containment because fear spreads faster than liquidity. But here is the deeper layer. Even if central banks inject unlimited reserves, that does not immediately restore confidence. Confidence is social. If depositors believe others will withdraw out, they withdraw first. This is a coordination problem. A rational panic. The system survives because most people assume others will not move. If that assumption breaks, behavior shifts instantly. And modern digital banking accelerates that shift. No lines, no friction, just taps. And yet the system has endured wars, financial crises, debt bubbles, pandemics, because central banks learned speed. In 2008, liquidity facilities were activated within days. In 2020, within hours. The architecture evolves to counter panic, but it cannot eliminate it. It can only outpace it. Here is the uncomfortable reality. Your bank balance is real, but it is real inside a leveraged network. Money today is not stored wealth. It is a claim on a system functioning. Normally it exists because borrowers are paying, because institutions are settling, because confidence remains statistically intact. If that confidence fractures across the board, the contraction is swift, credit shrinks, spending falls, investment slows, not because money disappears physically, but because willingness to extend it vanishes. So what actually happens if everyone withdraws their money? The system does not implode in spectacle. It constricts, limits emerge, liquidity surges from central banks, markets swing violently, volatility spikes, authorities stabilize or they fail to. The outcome depends less on reserves and more on belief, because belief is the ultimate reserve asset. The modern banking system is not fragile in isolation. It is fragile under synchronization. It works because withdrawals are random, because trust is diffuse, because panic is rare. If panic becomes universal, policy response becomes immediate, massive, coordinated, and potentially inflationary. Because the same mechanism that creates expansion is used to prevent collapse. New reserves, new guarantees, new backstops. Money can be created rapidly. Trust cannot. If everyone withdrew tomorrow, the question would not be, is there enough cash? The real question would be, how quickly can confidence be restored? Because money is not vault inventory, it is network stability. And network stability depends on collective restraint. Remove restraint and the multiplier reverses. Not with drama, but with tightening, with hesitation, with contraction. That is what would happen. Not empty buildings, not cinematic chaos. A sudden exposure of what money really is. A promise held together as long as everyone believes it will be honored. Imagine it begins at 9:12 a.m. Eastern. A prominent investor posts a warning. Liquidity concerns, no accusation, just doubt. Within minutes, institutional desks begin moving capital. By 9:40 a.m., wire requests triple. Retail depositors don't notice yet. By 11 a.m., Treasury departments across corporations begin defensive transfers. They are not panicking, they are hedging. By 1 p.m., interbank lending rates widen sharply. Behind closed doors, risk officers begin emergency calls. No headlines yet, just numbers flashing red inside private terminals. By late afternoon, ATMs in certain cities hit withdrawal thresholds. Not empty, just limited. Social media fills the silence before news outlets do. Screenshots circulate. Withdrawal delayed. Fear doesn't require confirmation. It requires visibility. and visibility is now instant. Money market funds tighten exposure. Short-term credit markets hesitate. Corporations that rely on overnight liquidity begin contingency planning. Payroll processors assess settlement risk. The public still believes this is isolated, but institutional confidence is thinning. Because banks don't fail when cash runs out. They fail when funding dries up, and funding dries up when trust evaporates. Central banks step forward, not dramatically, deliberately. Emergency facilities reopen. Swap lines activate between the Federal Reserve and the Bank of England. Liquidity injections expand quietly. Press statements emphasize resilience. Markets calm slightly, but something has shifted. People now understand something they were never meant to think about. Their money was not waiting in a vault. It was circulating constantly. Here is what rarely gets discussed. If liquidity freezes, companies feel it before households. Supply chains rely on short-term credit. Retailers rely on inventory financing. Energy firms rely on hedging markets. If banks pull back lending even briefly, corporate cash flow tightens. Hiring slows. Investment pauses. Small businesses already operating on thin margins feel pressure first. Not because vaults are empty, but because credit lines narrow. Money is access, and access is conditional. Human beings are not purely rational actors. If you believe others will withdraw first, you withdraw first. This is not ignorance. It is game theory. Modern banking survives because most people assume others will behave normally. The moment that assumption cracks, behavior synchronizes. Digital banking amplifies this. There are no cues, no friction, no pause to reconsider. A tap is enough. Why it hasn't collapsed? You might ask, if this system is so dependent on belief, why hasn't it collapsed already? Because belief is reinforced structurally. Deposit insurance reassures retail savers. Central bank backstops reassure institutions. Regulators stress test banks annually. Capital buffers are higher than they were in 2008. The system learns from crisis, but it never eliminates leverage, because leverage drives growth, and growth is politically necessary. Here is the part rarely spoken plainly. Money is not wealth. Money is coordination. It coordinates effort. It coordinates exchange. It coordinates time. The banking system is not a storage system. It is a coordination system. And coordination depends on trust. If everyone withdraws their money tomorrow, and what actually collapses is not cash supply, it is coordination. Transactions hesitate, credit tightens, economic rhythm slows, the machine doesn't explode, it stalls. And when it stalls, governments move rapidly, decisively, expensively, because allowing total contraction would mean accepting systemic reset. And modern economies are not built for reset, they are built for continuation. So what really happens? If everyone withdraws at once, limits appear. Liquidity floods in, markets swing. Confidence is repaired through force if necessary, because the alternative is too costly. The system survives, not because it is simple, but because it is defended relentlessly. But beneath that defense remains a truth most never confront. Your balance is not stored currency. It is structured belief, and belief is stable until it isn't. This is Money Mechanics. Subscribe if you want to understand how the financial system really works.